What are the tax implications of permanent residency in Portugal? Attention, Americans! If you are considering permanent residency in Portugal, you need to know about the tax implications. This topic is trending as many are looking to relocate to Europe for a better lifestyle. Understanding these tax rules can help you plan effectively for your future. Portugal offers a special tax status called the Non-Habitual Resident tax regime. This regime is available to new residents who have not been tax residents in Portugal for the previous 5 years. Under this regime, qualifying individuals can benefit from reduced tax rates or exemptions on certain types of income for a period of 10 years. Foreign-sourced income such as pensions, dividends, royalties, and interest may be exempt from Portuguese tax if taxed in the source country under a double taxation treaty or the Organization for Economic Cooperation and Development model. Certain Portuguese-sourced income, like income from high-value-added professions, may be taxed at a flat rate of 20%, which can be lower than regular progressive rates. To be considered a tax resident in Portugal, you generally need to spend more than 183 days in the country during a calendar year or have a permanent home available there. Once tax residency is established, worldwide income becomes subject to Portuguese taxation unless covered by exemptions or treaties. This means Americans with permanent residency who meet these criteria will need to report and potentially pay taxes on income earned both inside and outside Portugal. Portugal and the United States have a tax treaty that helps avoid double taxation. This treaty determines which country has the right to tax specific types of income and provides mechanisms to credit taxes paid abroad. Americans should use this treaty to prevent being taxed twice on the same income. Consulting a tax professional familiar with United States and Portuguese tax law is recommended to optimize tax obligations and ensure compliance. If you work in Portugal, Social Security contributions apply. However, if you are working remotely for a United States employer or self-employed abroad, you may remain subject to United States Social Security under certain conditions, especially if a totalization agreement applies. Understanding these rules is important to avoid double contributions or gaps in Social Security coverage. As a United States citizen, you remain subject to United States tax laws regardless of residency. This includes filing annual United States tax returns, reporting worldwide income, and reporting foreign bank accounts and financial assets. You may also need to pay United States taxes on income earned in Portugal, with foreign tax credits available to reduce double taxation. Obtaining permanent residency in Portugal can provide access to favorable tax regimes like the Non-Habitual Resident program, but it also requires careful navigation of residency rules, tax treaties, and dual reporting obligations. Americans planning to live, work, or retire in Portugal should seek advice from tax experts experienced in both United States and Portuguese systems to manage liabilities effectively and comply with all legal requirements.